Welcome to this explainer. Today, we're diving deep into an anonymous expert report on proactive tax strategy. Most people look at the tax code and just see a punitive, complicated labyrinth. But what if we completely reframe that? The analysis we're looking at today reveals that the tax code actually isn't just a rule book for taking your money. Actually, scratch that. It's more like an incredibly precise, expert-designed incentive map that mathematically rewards very specific economic behaviors.
So, let's kick things off with a bit of a paradox, shall we? Why in the world do high-income earners frequently end up paying a higher percentage in taxes than the ultra-wealthy? Well, according to the data, it really comes down to a mindset trap. High W-2 earners are usually trapped in this reactive cycle. They do the work, they collect their paperwork at the end of the year, and they just report history. But the ultra-wealthy, they are completely proactive. They are planning for the tax implications long before the wealth is actually even generated. And that brings us to a core difference: tax compliance versus tax strategy. It's really like playing defense versus playing offense. Compliance is totally defensive and reactive. It's fixated on that dreaded April 15th deadline and purely reporting financial history. Strategy, on the other hand, is an offensive, year-round approach. It relies on strategic entity structuring to actively minimize liabilities. It's the profound difference between just paying whatever you're told to pay and legally designing exactly what you owe.
All right, Section 1, the foundation. Structuring entities and income classification.
Now, a really common implicit assumption people make is that every single dollar earned is taxed equally. But the expert analysis shows that is just mathematically false. Not all money is treated the same. Ordinary income, like what you get from a standard W-2, gets hit the absolute hardest. Meanwhile, passive income is treated entirely differently, completely escaping heavy self-employment taxes. And then you have portfolio income, which enjoys those nice, favorable long-term rates. So how you classify your income, that is literally your very first strategic lever.
And the mechanism doing the most damage to that ordinary income, it's a very specific number: 15.3%. That is the self-employment tax rate. For sole proprietors and single-member LLCs, this thing silently drains your wealth. It takes a massive bite out of your profits for Medicare and Social Security before you even begin to touch standard income taxes.
But experts point out a brilliant structural shift to combat this, known as the S-corporation election. Once a business crosses roughly $50,000 in net profit, this becomes a vital tool. The profits still pass through to the owner, sure, but the income is strategically split between a reasonable W-2 salary and passive distributions. Let's break down the cause and effect of that structure in action. Under a standard single-member LLC, 100% of your net profits are subjected to that brutal 15.3% tax. No way around it. But under an S-corp, only your designated salary faces it. The remaining passive distributions are completely exempt from that specific tax. By just shifting your legal framework, you legally bypass a massive tax burden. It's a total game changer. Moving right along to Section 2, real estate incentives. These are your powerful growth levers.
Okay, this is one of the absolutely strongest tools in the entire playbook: real estate professional status, or REPS for short. Normally, paper losses from rental depreciation are trapped. They can only be used to offset passive income. But REPS dynamically reclassifies these activities from passive to active. And the result of that? Those massive paper losses can completely wipe out your high ordinary tax liabilities from a regular W-2 job.
Now, unlocking REPS does require some very exact criteria. You need 750 hours annually on real estate. It has to make up more than half of your total working hours, and you must show material participation. But here's the hidden strategic advantage for you. On a joint tax return, only one spouse actually needs to qualify. So one spouse can keep grinding at a high-earning W-2 job while the other secures REPS, effectively shielding their combined household income.
But hey, What if neither of you can hit that 750-hour mark? Well, there's an alternative mechanism, the short-term rental exception. If your average guest stay is 7 days or less, and you participate for just 100 hours, you completely bypass those grueling reps requirements. It's an incredible backdoor for high earners to utilize depreciation losses directly against their active income.
All right, Section 3, Energy Incentives, focusing specifically on oil and gas strategies.
Pivoting over to the energy sector, there's a massive government incentive built around intangible drilling costs, or IDCs. These are the non-salvageable expenses required to prepare a well. We're talking labor, chemicals, site clearing. By taking a working interest in these operations, independent producers are legally allowed to fully deduct these massive expenses against their active income in the very first year.
To really grasp the scale of this, just think about how a typical well's costs break down. IDCs make up roughly 70% of the total expense. Tangible equipment makes up the remaining 30%. And thanks to current bonus depreciation rules, up to 100% of both of these costs can potentially be deducted in year one. It is an unprecedented upfront tax shield that heavily rewards those who fund national energy infrastructure.
Section 4, Wealth Transfer. This is all about preserving your capital.
If you think about it, there's a fascinating implicit assumption the tax code makes here. It mathematically rewards patient capital. If you hold an asset for under a year, short-term capital gains tax hits you at your ordinary income rate, which, could be as punishing as 37%. But hold it for just over a year, and you drop right into favorable long-term capital gains rates, sometimes 0, 15, or 20%. The system is quite literally designed to pay you for your patience.
Now, for generational wealth, the step-up in basis is absolutely the ultimate preservation mechanism. Imagine you have an asset purchased at a $100,000 base that appreciates over decades to $500,000. Selling it while you're alive triggers massive taxes on that $400,000 gain. But if the owner leaves that asset to their heirs upon passing, the tax basis magically resets to the current market value. Decades of capital gains taxes legally erased in an instant. It's wild. But here's the catch. How you actually structure that transfer changes the whole shebang. A traditional will drags your heirs through public, time-consuming probate courts. A revocable living trust, however, is the structurally efficient alternative. It completely bypasses probate, keeps you in control while you're alive, and ensures that step-up in basis transfers seamlessly, and, most importantly, privately.
And finally, Section 5, Minimizing Audit Risk. Time to bulletproof your wealth.
Listen, reactive filers with messy, disorganized structures are incredibly vulnerable to algorithmic scrutiny. Expert analysts warn of very specific red flags that trigger an audit: reporting heavy losses on a basic Schedule C, mismatches between your reporting and third-party 1099 brokers, wildly out-of-the-norm home office deductions, and running cash-heavy operations without a clear digital trail.
So how do you shield yourself? The execution has to be precise. First, secure an EIN and strictly separate your business and personal bank accounts to absolutely eliminate commingling. Next, implement an official accountable reimbursement plan so those mixed expenses don't suddenly create taxable income. And finally, maintain pristine, rigorous digital logs for every single mile and receipt. That meticulous documentation, that is your armor.
We've covered a ton of profound ground today, but the core takeaway from this expert analysis boils down to one very simple idea. Don't just file taxes, plan for them. So, the question I'll leave you with is this: will you continue to be a reactive taxpayer, or are you ready to step up and become a proactive wealth strategist, designing your own financial reality? Think about it. Thanks so much for joining me on this explainer, and I'll catch you next time.